Physical Gold Fund presents the Gold Chronicles with Jim Rickards. Insights and analysis about economics, geopolitics, global finance, and gold.
John Ward, on behalf of Physical Gold Fund, we're delighted to welcome you to the latest webinar with Jim Rickards in the series we're calling the Gold Chronicles. Let me just remind those of you that know and introduce to those of you that are new to the webinar Jim Rickards. He's a New York Times best-selling author and the chief global strategist for West Shore Funds. He's the former general counsel of long-term capital management, a consultant to the U.S. intelligence community and to the Department of Defense. He's also an advisory board member of Physical Gold Fund. Hello, Jim, and welcome.
Hi, John. How are you?
Very good. Except, just to add to our little challenges, I'm recovering from a bit of a cold. If I cough for a moment, my apologies. I'll try to mute myself before that happens, but it is just possible. So, we also have with us Alex Stanczyk, the Managing Director of Physical Gold Fund. Hello, Alex.
Hello, John. Great to be here.
Alex will be looking out for questions that come from you, our listeners. So let me just say that your questions for Jim Rickards today are more than welcome. You can post them at any point during the interview. You'll see a box on your screen for typing in your question. And as time allows, we'll do our best to respond to you. Well, Jim, I'd like to begin with a recent statement made by John Paulson. He's a highly respected, well-known within the financial community hedge fund manager. Mr. Paulson said pointedly that we are not facing an imminent financial crisis. Obviously, he had a reason for wanting to say that in the current climate. Let me contrast that statement of John Paulson with a bulletin also recent from the Royal Bank of Scotland advising its clients to sell everything. So my question to you is kind of simple. How near are we to a really cataclysmic breakdown in the world's financial markets?
Well, on this question, John, and I'm certainly one of those who does see a cataclysmic breakdown coming, but I would say not yet. So I'm with John Paulson on this. I look at the landscape today. I look at the landscape over the maybe bridge line or the one after that. I think we can see 1987 was an example of a financial panic with no recession. 1990 is an example of a recession with no financial panic. And 2008 was an example of both. We had a very severe recession, the worst since the Great Depression, and a very severe financial panic. So the point is, there are different things. They can run separately or they can run together. Right now, while I certainly anticipate a financial calamity in the years ahead, I don't see that happening right now, but I do see a recession and a stock market decline, and that's the way to reconcile a lot of what you're hearing. So when Paulson says we're not facing an imminent financial crisis, I agree with that, but that's not the same as saying we're not facing a slowing economy, we're not facing recession, we're not facing a declining stock market, because I think we are facing all three of those things. So when someone like the Royal Bank of Scotland sends an advisory to clients saying sell everything, they're really commenting on the markets and the recession, not a financial catastrophe. So we can expand on that because I know we want to talk about the Fed and monetary policy and the impact on gold and some other things. But basically, I would say we're not facing a calamity, but we are facing a recession, further declines in stock markets, and a lot of volatility in exchange markets and gold. So a lot going on, but not quite the big one, as they say in California.
Well, let's look at an aspect that is, at least at the beginning of the story, is purely financial. Of course, it has economic implications. But I want to talk about negative interest rates. The negative interest rates have become something of a craze among the world's central bankers. We've got the European Central Bank, Japan, Switzerland, Sweden, among others, all piling in with this strategy. Now, by some estimates, that's about $6.5 trillion in sovereign debt, trading below zero. And even in the United States, the Fed has asked the banks to test the possibility of negative rates. And yet, at the same time, Janet Yellen continues to insist that the Fed is on course for raising rates, which all seems a little bit Alice through the looking glass. Can you help us make sense of the signals here?
Yes, I think when you say Alice through the looking glass, that's a very good metaphor, because once you cross zero, you are really through the looking glass in more ways than one. There are several reasons for negative rates. The main reason is to try to manage exchange rates and currencies. In other words, it's an extension of the currency wars. Now, the central banks will say this is for stimulus. That is, the theory is with the negative rate, I'm actually charging banks to have a deposit with me. So I'm the central bank, banks in my system. So in the case of the European Central Bank, we'd be talking about, Deutsche Bank, Credit Suisse, UBS, the other large European banks. They deposit money with the European Central Bank. And the European Central Bank is saying, fine, you deposit with us, we're going to give you less at the maturity of your deposit. We're going to take away part of your deposit. That's a negative interest rate. Instead of paying you interest, we're going to take something away. Now, superficially, they say, well, this is an incentive to go out and lend it. In other words, you can do one of two things with your money. You can lend it to some business or some enterprise or trade finance or commercial finance or anything you like, any commercial loan, or you can leave it with us and we'll take it away from you little by little in small increments. Therefore, that negative rate is an incentive to go out and lend. But in fact, that's really not different in kind than the incentives that we've had in place for the last 8 years. In other words, if I could lend money at 1% or 1.5%, how much does it matter to me if the rate's 0 or negative 25? Well, I guess if you go negative 25, negative 50, negative 1%, at some point it might matter, and maybe we'll get there. I mean, things certainly are moving in that direction. But the reason that the banks haven't loaned out the money is because nobody wants to borrow it. In other words, between regulators imposing strict credit standards, between corporations that the big ones have plenty of cash, the small ones are perhaps not creditworthy, or they're looking at below-trend growth and saying, why would we want to borrow money to buy plant and equipment or expand our capacity? Why would we want to do any of those things? We're worried about growth, we're worried about leverage, we're worried about a new recession, we don't want to borrow. Consumers, same thing. Consumers, when they get their hands on money, the tendency is not to spend it, but to either save it or pay down debt. So we have an excess of savings over investment. We have deleveraging in the form of paying off debt. We have banks that don't want to lend and consumers and businesses that don't want to borrow or spend. And so the system is jammed up. The transmission mechanism between central bank money and commercial bank money and lending and spending is very badly broken. So going down another 25 or 50 basis points isn't going to change that. The problem, the impediments are psychological, they're structural, they're long-term. It's not because interest rates are too high and they need to be lower. Interest rates have been very low, too low for a long time. As I say, the impediments are elsewhere, and lowering rates is not going to change that. So superficially, they will say this is designed to have a stimulus, but there is no stimulus. If 0 didn't do it, 25 basis points negative won't make much difference. However, there is a reason, at least in the minds of central banks, for lowering rates, including negative rates, and that's to fight the currency wars. It is designed to cheapen your currency. If you are a major institution, you're a sovereign wealth fund, or you're a very large asset allocator like BlackRock or PIMCO, or even a bank or the aggregate of all the savers in the world, if you're deciding where to park your money, you've got several choices. You can park it in Europe, you can park it in the United States, Japan, etc. At the margin, you're going to park it where you can get the highest rate. So if the U.S. is positive 25 or maybe soon to be 50 basis points and slightly higher for banks, and Europe is negative, then you'll put your money in the United States. Well, that means that at the margin, they'll be selling yen, selling euros, and buying dollars. That has a tendency to cheapen the euro. So there is an agenda, if you will, but the agenda is not normal stimulus through lending and spending. It's backdoor stimulus through currency wars, cheaper currencies, importing inflation. But the problem is, and that's why Europe's doing it, Switzerland has done it, and others are doing likewise, Japan, Sweden, and the other countries you mentioned. Now, the U.S. is not doing it. In fact, the U.S. is moving the other direction. The U.S. is in a tightening cycle. This combination of tightening in the U.S. and negative rates in Europe, of course, has driven the dollar at this point close to 10-year highs, and has driven the euro quite low. So that's the dynamic that's going on. The question is, where do we go from here? What's next for the U.S. Central Bank? What's next for Europe? And if you like, John, I kind of expand on that. Do a longer-term central bank forecast.
Well, I think it'll be helpful, actually, because I think the sense of what's the future of this is a question on all our minds.
Right. The Fed is still on a path to raise interest rates. I expect the Fed will raise interest rates 25 basis points in March and again in June. Now, I'll watch June carefully. I may update the forecast between now and then. In fact, I update my forecasts on a regular basis. But as I sit here today, I expect two more rate hikes by the Fed, 25 basis points each, one in March and one in June. And why do I say that? Because certainly if you listen to market chatter, if you look at the Fed funds futures markets, if you look at financial television, you hear the opposite. You hear that the Fed is suddenly going dovish. They did the one rate hike in December, but markets nearly collapsed in January. We went well into correction territory, depending on the market, into actually bear market territory. It wasn't quite as bad as the drop last August, but almost as bad. We had the Fed come out with their January statement that was released at the end of January, and then the minutes from that meeting, from the January meeting that were released yesterday, they were taken by the markets to strike a very dovish tone. And what has happened is that the market has now formed an expectation that the Fed will not raise interest rates in March. Of course, I'm saying that they will, so a bit contrary or well outside the consensus. But let me explain my view and sort of what it looks like the market is thinking. So the market, and when I said the market, I mean it shows up in the Fed funds futures markets, which based on where they're priced are showing that they don't expect any rate hikes in 2016 at all, with only a very small probability perhaps of one rate hike late in the year. And stock markets have started to rally. So what the stock market did, and by the way, go back to December when the Fed raised rates. I certainly, I had a year 2015 that they would not raise rates until December when I said they would, and the market certainly expected. I don't know anyone who did not think the Fed was going to raise rates in December. The rest of the year is history, but by December it was clear that they were going to raise rates. That was very, very well advertised. But I also said that would be a blunder. I was not in the group that said, a 25 basis point hike is not a big deal. It's only 25 basis points. Who cares? I said at the time that they would raise rates, but that it would be a huge blunder on a par with what they did in 1929. It would produce very, very adverse results. Well, that's exactly what happened in January. We all know what the stock market did in January and early February, and it went down quite a bit. But so the market was saying to the Fed, look, you have made a mistake. You've tightened into weakness. The Fed is not supposed to do that. They're supposed to tighten when things are strong and labor market conditions are tight and inflation is ticking up. That's when they're supposed to tighten. And when you're in economic weakness, you're supposed to ease. But here was the Fed tightening in weakness because there was a lot of weak data from trade and manufacturing output, trade, strong dollar. There were just credit losses, energy prices, commodity prices, shipments out of major ports. There were a long list. Retail sales, inventory skyrocketing. A long list of data that said the U.S. economy looked like it might be in a recession or heading for a recession. Why on earth would you tighten in that environment? Well, the Fed tightened anyway, and the reason is that they are not really looking at real-world data. They're looking at their models. They have a Phillips curve model. They have something called NIRU, the non-accelerating inflation rate of unemployment. We don't have to debate the technicals of those models except to say that they're, in my view, they're pretty much junk science that don't really have any real-world validity. That's what the Fed was using. So the Fed was tightening based on models that told them growth would be okay and inflation was right around the corner. Meanwhile, the real world is seeing weakness all around, seeing the Fed tighten, and said that's a blunder. So the stock markets collapsed over the course of January. But then a funny thing happened in the last couple of weeks, which is the minutes, the January minutes came out, as I mentioned, and they were interpreted by the market as striking a very dovish tone. Now, what was the basis for that? Well, if you go look at the language, the Fed acknowledged the financial stress that we were all seeing in the month of January. They said, Chinese markets are going down, U.S. markets are going down, markets are volatile, financial conditions are tightening, growth appears to be slowing. They listed a litany of things that would indicate that they recognize that the U.S. economy is fundamentally weak. So the market said, okay, good, the Fed got the message. They tightened in December. That was a mistake. The markets went down, but the Fed heard us. And now the Fed is acknowledging that the economy's weak and they won't tighten in March. Now, here's where I disagree with the markets. But markets are wonderful price signals. They're wonderful aggregators of information. I follow them very closely, but they're pretty bad forecasters. So I don't rely on them on forecasts, but I do rely on them for information. Of course, the art of the exercise is to interpret it correctly. What I saw the market doing when they looked at these Fed, first the statement, then the minutes, and went down the slate of weak factors, I think they ignored something else the Fed said, because the Fed said, yeah, we have weakness here, volatility there, tightening financial conditions. We're watching it very closely. And that was the key phrase, because watching it means that they haven't changed their minds. In other words, they set out on a path to raise rates, certainly in March. Some unexpected things happened. They acknowledged the unexpected things, and they said they're watching it, but that tells me that they haven't seen enough yet to change course, because if they had, they would have said that, but it's not what they said. They said, we're watching it, and we're going to keep thinking about it. That means they're not changing course. And whenever you answer one question, it should always pose another question. And so what I said to myself was, okay, the Fed's still on course to raise rates. The market has kind of looked at the dovish part of the statement, but I looked at the part that said, yeah, well, there's some dovish factors out there, but we still haven't made up our minds. So that tells me they're still on course to raise rates. But then I said, well, what would it take if they're watching this data? What would it take for the Fed not to raise rates? In other words, it's not bad enough yet. That's what they said, but how bad would it have to be? Well, we do have some information on that, which is the collapse last August, particularly the last week of August, and the fact that the Fed did not raise rates in September 2015, when they were widely expected to raise rates, certainly all year by a lot of commentators, but in the run-up to September 15th, it was very widely expected until the last few days that they would in fact raise rates, and they didn't. So there's an example when the Fed did change course based on market information, and using that applied to today's markets, where would the S&P have to be for the Fed not to raise rates? That was the question I asked myself. And the answer is about 1650. You know, that's an estimate, and it could be a little bit higher, a little bit lower, but you would have to see the S&P crash from where it is now around the 1920 level all the way down to 1650 for the Fed not to raise rates. What about jobs? We're going to get a jobs report on March 4th. That'll be the February jobs report. That'll be the last big piece of data before the Fed has to make their decision on March 16th. The January jobs report that came out in early February was decent. It wasn't huge. It looks like monthly job creation actually peaked in November 2014, right around the time the stock market peaked, by the way. That's when the trouble began. There was a delayed or lagged reaction to the Fed tightening beginning in the spring of 2013. But anything above 100,000, it's not a blockbuster report, but it's good enough. So my estimate was that in order for the Fed not to raise rates, you'd have to see a February jobs report of, say, less than 100,000 new jobs on March 4th, and you'd have to see the S&P tumble down to the 1650 level over the next couple of weeks. If both of those things happened, then the Fed would not raise rates in March. But I don't see either one of those things happening. I think the jobs report will be okay, not huge, but good enough. And the stock market down, but there'll be counter rallies, and it's not going to hit, even 1,700 would be a shock, but I don't see it hitting 1,650. So with the sort of 1,650 on the S&P and sub 100,000 jobs in the February jobs report being my benchmarks, and neither one of those things happening, I don't see the Fed being deterred from raising rates in March. Beyond that, the market has made the Fed's life easier because of what's called a recursive function. That's just a fancy name for a feedback loop. So go back to the December, January, February sequence. The Fed tightens in December. The market decides the economy is weak. That tightening in weakness is a mistake. So the market goes down. Then the Fed acknowledges the market's concerns. The market interprets that as being dovish, and the market rallies. Well, the irony of that is the market rallying makes it easier for the Fed to raise rates. In other words, markets are rallying in anticipation that the Fed won't raise rates because of a statement, but the market rally itself makes it easier to raise rates because it eases financial conditions. So it's the exact opposite of what the market may be expecting. So all of that is a setup for possibly a shock on March 16th, where if the Fed tightens as I expect, but if the market's looking for no action, certainly nobody thinks the Fed's going to ease, take back the 25 basis points that they raised, but even doing nothing would be sort of dovish from the market's perspective. So if the market expects the Fed to do nothing and the Fed tightens, that could be a shock. So we could see much bigger declines in the stock market between now and then, and perhaps even very much concentrated on March 16th if the Fed actually does tighten, which I expect.
Well, thanks, Jim. Let me just take a moment to ask a broader question about investor confidence. I'm not talking about confidence in the market or in companies, but confidence in the monetary system. Do you see any kind of erosion of trust in the financial elites and in central banks in particular, not only the Fed, but the central banks around the world?
Well, I do. In 2008, of course, the central banks rode to the rescue, bailed out Wall Street, bailed out the banks, bailed out the economy, money market funds, bank depositors, you name it. There were tens of trillions of dollars of rescue packages put together. And it did have the effect of preventing something much worse than what happened. But unfortunately, it did not solve any of the root problems. And those problems have manifested themselves in two ways. Number one, persistent below-trend growth. I think most economists would have said, okay, we went through a bad patch in 2008, 2009, but maybe by 2010 or 2011 at the latest, we should have seen the economy getting back to consistent, 3.5, occasional 4% growth, and of course that never happened. I mean, there were some individual quarters where that happened, but on the aggregate, no, certainly not globally, and not in the United States, and not for any sustained period of time. And so that being the case, there's just the passage of time by itself would be enough to cause some loss of confidence in the central banks. But beyond that, and making it even worse, is just the inconsistency in policy, the sort of the blindness of the Fed, raising rates in December. What happened in January? Would you have raised rates in December if you knew the market reaction would be so bad? Well, a few people, myself included, predicted that market reaction, but the Fed certainly missed it, and now investors are well aware that the Fed missed it, so they're losing confidence in the central banks. Now, for evidence of this, it's one thing to describe that, but when you look for concrete evidence, I see it in the price of gold. And the reason I say that is there are a lot of reasons why the dollar price of gold might go up, might go down. And I think our listeners are familiar with a lot of them. There's inflation, deflation, negative real rates, positive real rate. There are a number of factors, normal supply and demand, that we've spoken about, and we'll talk about on future calls as well. But for now, I just want to focus on one very particular and I think important aspect, which is until November 2014, until around the end of 2014, the dollar price of gold was very highly correlated to the commodity price index. And there are a couple of big commodity price indices out there. I'm using the Goldman Sachs composite, but the same would be true for other commodity indices as well. They were very tightly correlated. Well, that makes sense. It should be correlated. I mean, first of all, gold is in the index, so a single component should be somewhat correlated with an index that includes that component. But beyond that, they respond to a lot of the same forces, including, as I say, inflation, deflation, and interest rates. But beginning in November 2014, they very sharply diverged. The commodity index continued to collapse, driven mostly by the price of oil. We all know the oil story. But gold went up. Now, it went up and then it came down again. It was volatile, but it found a floor right around that 1060 level, $1,060 an ounce. Bounced off that floor a couple times. And, of course, it's had a very strong rally, about a 14% rally over the past 3 weeks, and I'm sure our listeners are very well aware of that. So what does it mean when commodities are still going down, bouncing around the bottom, but gold has broken away from the pack and started to move up? What that tells me is that gold is no longer trading as a commodity. It's trading as money. And gold has this, I've written a couple columns recently where I call it a chameleon. You put a chameleon on a green leaf, it looks green. Put a chameleon on a tree trunk, it looks brown. It changes color to adapt to the environment. And gold changes its characteristics. It's always gold. In my view, it's always money, but in terms of broader markets and the perception, sometimes it trades like a commodity, it trades like an investment. And if there's a flight to quality and people are dumping stocks and bonds, they might buy gold and think of gold as another asset class or another investment. But sometimes it acts like money. And my view right now is gold is acting like money. It's in the horse race between the dollar, the euro, the yen, the yuan, and all the other major currencies. And people are starting to look at gold as an alternate currency, an alternate form of money. That explains why gold is going up, and it also explains why it's broken away from the commodity index. So some people call it the fear trade. Maybe there's a little bit of that in there, but I see it as gold as a form of money, and that by the way, is very symptomatic of the loss of confidence in central banks. Because what's the competition? If you say gold's a form of money, well, what's the competition? Well, yeah, Bitcoin in a small way, but the real competition is central bank money. It's the dollar, the euro, the yen, the yuan. So if people are losing confidence in all the central banks and they're looking for a form of money, the only thing left is gold, and to me that accounts for why gold is going up. So the short answer to the question is yes. As a result of the central bank's inability to see the stock market collapses in January, as a result of their blunders, very tightly compressed between raising rates in December and sinking markets in January, there's a generalized loss of confidence in the ability of central banks to steer economies. I never had much confidence in them in the first place. I don't think that's their job, but I think most people do. Most people do think the central banks know what they're doing, which of course they don't. But so I think that confidence was lost, and that's showing up in the increase in the price of gold, which is people are going to as a form of money that's not printed by central banks.
Well, speaking of gold, Jim, last month you shared with us exciting news about your latest book. It's called The New Case for Gold. May I ask you something about that book? As you were working on it, did you make any new discoveries for yourself about either the historical role of gold or its future potential in the global monetary system?
Well, I did, John. It's a great question. Of course, when you set out to write a book, you have a topic in mind, you have an outline in mind. So you start out sort of knowing where you're going, but then you actually do the research and start to look at a lot of different threads and just think about it. And actually, the writing process itself is a creative process, and sometimes you get into what psychologists call the flow. You just start writing and you just keep going. That's a source of a lot of creativity. And one idea that emerged, and this really draws on my background in the bond business and in government finance, because obviously today I write about gold and I speak about gold a lot, and of course I'm on the board of advisors of the Physical Gold Fund, and I have this new book coming out on gold. But it's something I've done a lot in the last 10 years. But for that, I was really in banking and hedge funds and government finance and the bond background. I'm very familiar with open market operations. And I started to go down a list of objections to gold. We all know what they are. So, you run into people, they say, gold is a barbarous relic, or gold has no yield, or gold is not part of the money supply, never will be. There's not enough gold to have a gold standard. I think we all know I call it the litany of reasons not to own gold. Every one of those things, all the ones I just mentioned, are wrong. They're either factually wrong, historically wrong, analytically wrong. And I write about that in the book. So I take them one by one, and I kind of rip them apart and leave the reader with a very, in my view, good historical, factual, analytical foundation on which to rebut the gold bashers. So if anyone picks up this book and reads it, and then whether they're on television or at a cocktail party or dinner party or among friends, or just behind the wheel listening to the radio, and you hear some of these arguments against gold, I hope everyone will be well armed with the rebuttal, because that's all in the book. So I hope the readers enjoy that. But one particular plot, people say, well, there's not enough gold to have a gold standard, because you look at the current price and you look at the total volume of bank assets, trade and finance, capital flows, and just look at the size of the world economy, look at the amount of gold, look at the price of gold, and could you have gold backing up the global economy today? And the answer is, well, the superficial answer and the incorrect answer is no. But the correct answer is, well, of course there's enough gold. You just have to change the price. In other words, there may not be enough gold at $1,200. That may be deflationary relative to the money supply, but there's plenty of gold at $10,000 or $20,000. In other words, the same quantity of gold can do service to any amount of money supply, any amount of economic size, simply by raising the price. So to say there's not enough gold is nonsense on its face, because there's always enough gold. It's just a question of price. So I talk about that. There are some historical antecedents for getting the price wrong, going back to the 1920s, and in the future, if you ever had a gold standard, you have to get the price right. But beyond that, another idea occurred to me, and it had not occurred to me earlier. I've never seen it. I've never seen it in print or discussed anywhere. It's one of the things that I explore in the book, one of many, by the way, that I hope the readers find new and interesting, which is that the critics who say there's not enough gold fail to distinguish between official gold and total gold. In other words, the total amount of gold in the world is about 180,000 tons. That's an estimate. It could be a little higher, a little lower. And the amount of official gold in the world, when I say official gold, this is the gold owned by central banks and sovereign wealth funds, they're basically owned by governments, is a much smaller amount. It's about 35,000 tons. Whenever I've done any of my calculations or spoken about $10,000 gold, whenever people talk about, is there enough gold to support the global monetary system, et cetera, they're always doing the calculations, and I do the calculations with reference to that 35,000 tons. And mining output is about 2,500 tons a year, give or take, and so that grows about 1.5% a year relative to the total stock. Well, if you're a central bank and you want to ease monetary policy and you're on a gold standard at a fixed price and you say, gee, I don't really have enough gold, all you have to do is buy some. In other words, you can go out and buy gold from the floating supply of non-official gold. So the answer is you're not limited to 35,000 tons. You've really got 108,000 tons. Official gold is only about 20% of the total gold supply. There's 80% out there waiting to be had. And when you go out, if you're on a gold standard and you're a central bank and you print money and buy gold, that's what's called an open market operation. It's exactly what central banks do today in the bond market. So when a central bank such as the Fed wants to ease monetary policy, what do? They buy bonds. They buy bonds from banks, and they pay for them with money that comes out of thin air. They just credit the bank's account. So in effect, they print money to buy bonds. What do they do when they want to tighten monetary policy, when they want to raise interest rates? Well, they sell bonds. They sell the bonds back to the banks, and the banks pay for them, and then the money just disappears. It's as if it went into a black hole. So buying bonds from the market with newly printed money and then selling bonds back to the market with money that disappears, those are called open market operations, and that is how central banks control interest rates and try to regulate inflation, deflation, and economic growth. Well, you can do exactly the same thing with gold. If you think that there's not enough gold at a fixed price and you want to ease the monetary conditions, you can print money and buy gold. Likewise, if you think inflation is getting out of control and you want to tighten monetary conditions, you could sell gold and be paid for it. And if you're trying to target a price, and of course, as I said before, you have to get the price right, that would be a way to target the price. So if you started your gold standard at, let's say, $10,000 an ounce, and I think that's a reasonable estimate, and you had a side-by-side free market in gold, and gold started going up to, $10,500 an ounce or $10,700 an ounce, some significant move like that. Well, that's a price signal to the central bank that their monetary policy is, too easy. So what they could do actually is basically sell gold into that market to try to lower the price. Start dumping gold, you lower the price. Conversely, if you see the price of gold going down to, say, $9,500 an ounce when your target is $10,000, you can go buy gold and print money and bid up the price. So in other words, you can treat gold exactly the way they treat bonds today. You can buy it and sell it in an open market operation. You can do that to target the price, and you can do that to target any combination of monetary ease or tightening that you wanted. So that's a technical way of saying this objection to a gold standard on the basis that there's not enough gold, leaving aside that there's always enough gold at a price. There's a deeper objection to that, which is that there's plenty of gold on the sidelines in private hands, and you can buy it and sell it through open market operations and hit any target price of gold you want, or create or destroy money exactly the way you do today. So in other words, there's no inconsistency between a gold standard and discretionary monetary policy. There's no inconsistency between a gold standard and open market operations. So when you throw in all the private gold side by side with official gold, the idea that there's not enough gold just falls away. So it's one of these things. It's cliche. People throw it out at you, but if you know if you understand the ins and outs. And by the way, PhD economists and monetary economists and central bankers would understand perfectly everything I'm saying. So why did they not say it? Well, the answer is they don't want to talk about it. They don't want a gold standard. They don't want to say anything positive about gold. So I separate the critics, those who know what they're talking about but are kind of not honest and acknowledge these arguments, who are sort of an echo chamber, if you will. They just repeat the argument without really thinking about it. You can see that there's plenty of gold. There's more gold on the sidelines. That gold standards are feasible. You do it to get the price right, but that target price would be $10,000 an ounce or higher.
Oh, thank you, Jim. It's an intriguing picture and certainly new to me. And now Alex Stanczyk is here with questions from our listeners. I'm sorry, time is a little short because of our hiccup at the beginning, but still we've got some minutes left. And Alex, would you take over here and share with us questions from the listeners?
Sure, John. Thank you. Very briefly, before we get started on the questions, we encourage people to always give us questions however they like. They can send it in by email. We have an interface here for you to ask questions this way. You can also ask questions on Twitter with the hashtag AskJimRickards. And we will always monitor for those. And if we don't pick it up, for example, in this webinar, we can pick them up in possibly future webinars. A question that's coming in quite a bit right now is how do we get the book? You can go to the newcaseforgold.com. There's a link there that will take you to Amazon. Otherwise, you can just go straight to Amazon and search for it. It's available for pre-order now. The special edition is not available on Amazon. That's going to be done completely separately, but you can order the standard edition that way. Some questions that come in have to do with asking what amounts to financial advice, investing advice, tax advice, or legal advice. We typically try to stay away from those kind of questions for obvious reasons. One question that is pretty common right now, Jim, we've got 3 different people asking about this particular topic. It all has to do with cashless. One comment is, will cash be even more valuable in the black market if they try to go cashless? Another question is, there's so much eagerness with bankers to ban cash. How would you see that play out? And then there's another one here. This one's coming from Nathan. Recent news regarding elimination of the $500 euro bill and the $100 US bill. Can you talk about this a little bit?
Sure, and I know there's a lot of interest in it, and there was a Harvard professor who had a report on this, and Larry Summers blogged about it. I've spoken a little bit about it on Twitter, and I know it's generating a lot of interest, so let's kind of hit this one head on. The idea of a cashless society, first of all, we are moving in that direction. There's no question that governments around the world would like to go to a cashless society. They know there'll be some resistance, and they don't want it to be a political issue moving in that direction, and sort of the more culturally homogeneous the society is, the more likely you'll see it. So I think we may actually see this in the next year or so. In Sweden, they're pretty far down the road. Europe would like to do it, et cetera. So we are moving in that direction. Another quick point, a lot of people associate the cashless society with negative interest rates. Of course, negative interest rates are here. They're in Japan, they're in Europe, they're in Sweden, they're in Switzerland. They may be coming to the States. It's not right away. I don't think we'll get to negative interest rates in the U.S. until perhaps the middle of 2017. That's because we'll have a couple more rate hikes, and then I think the Fed will pause, and then before they get to negative, they have to cut, because once you get up to 75 basis points, you got to get back down to 0. So that means 2 or 3 cuts. But if they raise in March, raise in June, pause in the fall, cut in January, February, March of 2017, you're going to be all the way out till April 2017 before you see negative rates in the U.S. Having said that, I think we may see negative rates in the U.S. I think they'll do that before they do QE4, and they'll also try to do helicopter side by side. So we are moving to negative interest rates, and we may see them in the United States next year. And a lot of people say, I know a way around negative interest rates. I'll just go to the bank and get a bunch of cash and stick it in a shoebox and bury it in my backyard, and all my friends, they'll have the money in the bank, and they'll be finding they have less every year because they're taking the money away at negative interest rates, but I'll still have all my money because it's in the shoebox. Now, that's actually not feasible. I think the war on cash is over. I think the government won. I think people who think they can get a lot of cash are fooling themselves. First of all, corporations can't do this. I mean, Apple, I think, got to check, but maybe $1 trillion of cash on its balance sheet. It has an enormous amount of cash. So you're not going to get $1 trillion in $100 bills and stick it in your backyard in Cupertino, California. So the large players, the BlackRocks, the PIMCOs, the Apples, any company with large cash balances, they're not going to get currency. So we're only talking about individuals, and individuals are actually not that big piece of the puzzle because the real impact of negative rates is going to be indirect through mutual funds, through corporations, through stocks that you own. So the big players, it's just not feasible to get cash. But even for everyday citizens, and a lot of our listeners, you cannot go to the bank and get $20,000. I mean, call your bank tomorrow morning and tell them you'd like to withdraw $20,000 in cash. First of all, you'll hear silence on the phone. Then they'll tell you, it's not illegal. They'll say come back in 3 days. because we've got to get the money. And when you better bring your birth certificate and 20 forms of photo ID, because they're going to want to know your whole life history. So the called a CTR, currency transaction report, doesn't make you a criminal, but you're on some radar screens. So really hard cash without being treated like a criminal, a tax evader, or a terrorist. In fact, you will be treated like a criminal, a tax evader, or a terrorist, even though you're a perfectly honest citizen. So people who say to themselves, oh, I've got this figured out, as soon as they go to negative rates, I'm going to march down and get some cash, you can't get it. For that matter, you can withdraw $5,000 a week for a couple of months to say, well, they won't file the currency transaction report, but they'll file something else called a suspicious activities report, SAR. So, you're on the radar screen. So as a practical matter, you can't get your cash. But one of the callers, part of the question I heard, Alex, was, well, that aside, maybe I'll do it anyway and let them file a report. Who cares? I pay my taxes. I'm an honest citizen. I have nothing to hide. If they want to send in a report to the Treasury, that's fine, but it doesn't really matter. I'm going to get my cash, which you can do. But the question was, would it possibly be worth more on the black market in a time of a cashless society? And the answer is no, because if they go cashless, I can tell you what they're going to do. They're going to call in the money. They're going to be public announcements say, you have 90 days to come down to the bank with your cash and hand it in, and we'll give you credit in a digital account, in your bank account, basically. But anybody who doesn't do it within the 90 days, cash will no longer be valid. It'll be like confetti or newspaper. And by the way, this happens all the time. I say these things, and people look at me like, "Boy, Jim, you're writing science fiction here." It happens all the time. How do you think they got to the euro? In 1999, you didn't have the euro. You had Italian lira, you had Spanish pesetas, French francs, German Deutschmarks. You had whatever it was at the time, 14 different currencies. This is what they did. They said, "Hey, everybody, you've got X number of days to come down with your Deutschmarks, your Spanish pesetas, or whatever it is, cash them in, and we'll give you euros." Well, you could get paper money. There's still a paper euro, but if you have Deutschmarks today, they're worthless. If you have Deutschmarks sitting in a drawer, they're worthless because you are past the time that they gave you to come in and cash them in. So I would say two things. Number one, the cashless society is already here in effect because it's just not practical to get your hands on very much cash. Number two, even if they did make it a matter of law so that it was literally illegal and impossible to get cash, you'd have a certain amount of time to hand it over. Of course, in doing so, you would also be reported to the government, and therefore, your cash isn't going to do you any good. There's not going to be a black market because it's just going to be worthless. However, everything I just said does not apply to gold. So if you're worried about the digital society, the cashless society, if you're worried about the government calling in $100 bills and writing down the names of everyone who comes in with a stack of hundreds, if you're concerned about all that, you ought to buy physical gold because that will always be valuable. The government can't make it go away. That's really the alternative. So I wouldn't be trying to load up on $100 bills. You might be trying to load up on physical gold because that's really the answer to being stampeded into digital accounts which the government can then steal from.
Okay, I know that's been on the mind of a lot of different people and in a lot of different ways. So thanks for covering all of that, Jim. Now we still have quite a few more questions. There's at least 24 here in the queue, but unfortunately we're out of time due to the little hiccup that we had with on the technology end in the beginning of the webinar. So thanks, Jim, for your time. We really appreciate your insight as usual. And with that, I'm going to turn it back over to John.
Well, thank you, Alex, and thank you from me to you, Jim Rickards, and on behalf of all of us. It's always a pleasure and an education having you with us. And most of all, thank you to our listeners for spending time with us today. Let me encourage you to follow Jim on Twitter. His handle is @JamesG.Rickards. So goodbye for now, and we look forward to joining you again soon.
You have been listening to The Gold Chronicles with Jim Rickards, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers. Physical Gold Fund presents The Gold Chronicles with Jim Rickards. Insights and analysis about economics, geopolitics, global finance, and gold.
Gold. On behalf of Physical Gold Fund, we're delighted to welcome you to the latest webinar with Jim Rickards in the series we're calling the Gold Chronicles. Let me just remind those of you that know and introduce to those of you that are new to the webinar Jim Rickards. He's a New York Times best-selling author and the chief global strategist for West Shore Funds. He's the former general counsel of long-term capital management, a consultant to the U.S. intelligence community and to the Department of Defense. He's also an advisory board member.
And someone like the Royal Bank of Scotland sends an advisory to clients saying sell everything. They're really commenting on the markets and the recession, not a financial catastrophe. So we can expand on that because I know we want to talk about the Fed and monetary policy and the impact on gold and some other things. But basically, I would say we're not facing a calamity, but we are facing a recession, further declines in stock markets, and a lot of volatility in exchange markets and gold. So a lot going on, but not quite the big one, as they say in California.
Well, let's look at an aspect that is, at least at the beginning of the story, is purely financial. Of course, it has economic implications. But I want to talk about negative interest rates. The negative interest rates have become something of a craze among the world's central bankers. We've got the European Central Bank, Japan.
1987 was an example of a financial panic with no recession. 1990 is an example of a recession with no financial panic. And 2008 was an example of both. We had a very severe recession, the worst since the Great Depression, and a very severe financial panic. So the point is, there are different things. They can run separately or they can run together. Right now, while I certainly anticipate a financial calamity in the years ahead, I don't see that happening right now, but I do see a recession and a stock market decline, and that's the way to reconcile a lot of what you're hearing. So when Paulson says we're not facing an imminent financial crisis, I agree with that, but that's not the same as saying we're not facing a slowing economy, we're not facing recession, we're not facing a declining stock market, because I think we are facing all three of those things. So when
financial community hedge fund manager, Mr. Paulson said pointedly that we are not facing an imminent financial crisis. Obviously, he had a reason for wanting to say that in the current climate. Let me contrast that statement of John Paulson with a bulletin also recent from the Royal Bank of Scotland advising its clients to sell everything. So my question to you is kind of simple. How near are we to a really cataclysmic breakdown in the world's financial markets?
Well, on this question, John, and I'm certainly one of those who does see a cataclysmic breakdown coming, but I would say not yet. So I'm with John Paulson on this. I look at the landscape today. I look at the landscape over the maybe bridge line or the one after that. I think we can see
of Physical Gold Fund. Hello, Jim, and welcome.
Hi, John. How are you?
Very good. Except just to add to our little challenges, I'm recovering from a bit of a cold. If I cough for a moment, my apologies. I'll try to mute myself before that happens, but it is just possible. So we also have with us Alex Stanczyk, the Managing Director of Physical Gold Fund. Hello, Alex.
Hello, John. Great to be here.
Alex will be looking out for questions that come from you, our listeners. So let me just say that your questions for Jim Rickards today are more than welcome. You can post them at any point during the interview. You'll see a box on your screen for typing in your question. And as time allows, we'll do our best to respond to you. Well, Jim, I'd like to begin with a recent statement made by John Paulson. He's a highly respected, well-known within the